In today's video, I'm going to break down my strategy that makes me profits almost every single day. It presents in the first hour of the market open, and the best part is you don't need multiple time frame analysis, you don't need daily buys or multiple indicators. So with that being said, I'm going to break it down step by step so even a complete beginner could understand it and make profits using it. So let's actually get into it. But just before we actually start, I want to show you how my February of 2026, which is this month right now, is ongoing. So it's 25th of February right now, and you can see I'm up $27.5 thousand. So you can see I even didn't take trade every single day, but I'm still in the huge profits, and you can see the win rate for this month is 85.71%, which is absolutely huge. And that's literally it. You can see all of these trades. You can actually check them out on my other channel that I will leave down there in the description. So let's actually get into the steps. Alright, so here we are at step number 1. So this video is going to be no fluff. We are just going to go step, and then we are going to go straight to the chart so I can show you some kind of real example. So step number 1 is going to be to mark out key liquidity levels on the 5-minute time frame. So the point is, when you come to the session at 9:30, so you can see we want to trade in New York session or Asia or London session, but we want to come at the market open. When we come to the market open, which is this candle right here, what we want to do is on the 5-minute time frame, we want to mark out highs and lows in the market. And why do we want to mark out highs and lows? Just so you know some kind of concept behind this strategy is when we mark out every single high and low in the market, not every single but important ones, which I'm going to show you on the chart how to know which ones are good and which ones we don't really care about. So the logic behind it is that actually when market is making structure like this, so you can see it's basically going up and down, what every single high and low in the market actually has is something called liquidity. And in simple terms, it is just a lot of orders on this high right here and a lot of orders on this low down here. And what orders are, it's just stop losses from other traders, so from traders like me and you, but from 97-98% of unprofitable traders who are going to enter the trades and place their stop losses on lows and highs before the actual manipulation happens. So very important is to mark for the step number 1 highs and lows on the 5-minute time frame. So let's go on to the next one. So the second step is, of course, after the market open actually happens, we want to wait for one side to be swept. And what we want to do is when the one side gets swept, we want to look for the entry towards the other side. So I'm going to show you the entry right now. But the logic behind this is, as I said, we have already stop losses down here and stop losses down here, something that is called liquidity. So we are always, not we, but the market is always kind of going to hunt stop losses and liquidity, and that is why the market is going to do specific patterns where we get the one side of the stop losses, the liquidity. So like this, we are going to sweep it like this on after the market open, when the big boys, the institutions, the banks actually come into the market, because if they want to enter the market, they need to stop the masses out. So first of all, they manipulate the market towards the downside. Then when they stop everybody out right here on some kind of low or high, what do? They massively buy into the market, because then they have kind of opposite side in the market that they can buy from. So since everybody is getting stopped out, that means that everybody is selling in the market. And what are they going to do in this example? They are just going to buy the market towards another liquidity point where they can basically do what? They can sell. So they can buy right here for the lower price from these stop losses from the unprofitable traders who are going to put their stop loss right here. And when they buy from them for a discounted price, they will push the market to the upside, and they will bring the market to another side of stop losses, which is this high right here. And what are they going to do here? They are going to sell, and that's basically it. They bought here at the discount and sold here at premium, which means that they actually made money with their position. So what are we going to do? We are just going to replicate what the market makers are actually doing. So the second step is to wait for the one side of this liquidity to get swept, but we are going to actually do it on the 1-minute time frame. So all we did on the 5-minute time frame was we marked out highs and lows like this, and what we do is we scale down to the 1-minute time frame and we just wait for the manipulation, so for the sweep of either upside or downside, and that's the second step. So now once we actually have the sweep of this low or high in the market, what we want to do is we want to look for this pattern on the 1 minute time frame. So this is almost always, like I like to say it, 90% of the times we are going to get the entry. If we don't get the entry, we just do not execute any positions. So when we get the sweep, so you can see the sweep right here, so this is the candle that actually swept the low, what we look for is a fair value gap. So fair value gap is something very smart in the market that I always use. And what a fair value gap is, it's an imbalance in the market. So you can see that market, while it was pushing towards the downside, it left this imbalance. So you can see this candle displaced quite a lot towards the downside, leaving us with this kind of hole in the market, which market loves to retest. So it can actually continue going to the downside, but we are going to use it kind of way smarter than all the other people are. So we have a imbalance right here, so a fair value gap. It's just a formation of 3 candles where there is a separation between the first candle's wick low and the third candle's wick high, or in the other case, when the market is going to the upside, it's just the first wick's high to the third wick's low. So why is it so important to us? Because how do people actually use fair value gaps? So people use fair value gaps to basically see some kind of retests from them. So what are people going to expect? They're going to expect that market is going to come into the fair value gap and bounce back off and just continue to the downside. So that's how they all look at fair value gaps, and that is probably the reason why they are unprofitable. So how we are actually going to tackle fair value gaps and to look at them is we are going to wait for the market to clearly show us that it does not want to respect the fair value gap, that it actually disrespects it, and that is exactly when we enter. How do we know when that is? We want to see a candle closure above the fair value gap. So if we actually manage to close with a candlestick above the fair value gap, that means that market actually does not want to respect it, because if we did want to respect it, we would just wick out of it. So if we respected it, it will look something like this. So all we need to see is market actually close above, and that is going to make us be ready to actually enter the market. So all 3 steps are marking out highs and lows on the 5-minute time frame, going down to the 1-minute time frame, waiting for a sweep of the one side, and the third step is on the 1-minute time frame, just finding a fair value gap that was created while going towards the sweep and wait for it to get disrespected. So if we get a respect like this, we just wait, because market maybe wants to do one more manipulation like this of the last low created, and then we just enter off of the new fair value gap, which is likely to be created here. If it doesn't, and if we do not get the entry, what we do is we just do not execute anything, because there is going to be another day where we can catch a better opportunity. So now let's just go through it once again so we can put it all together before we actually go to the live chart. So first thing is high and low on the 5-minute time frame. After that, on the 1-minute time frame, all we do is we wait for the sweep of either one of those sides. So it's not important if it's upside or the downside. In this case, it was the downside. So what we do is, in the third step, we want to find a fair value gap that we are going to actually disrespect to the upside. And what are we going to target? We are going to target another side. So one more thing that we just need to be aware of is that we want to be inside of a market session. So it doesn't need to be New York specifically. I personally trade New York, but you can do London, Asia, but it has to be market open. And now I just want to give you some kind of rules so you can even profit more and have higher win rate with this strategy. So the first thing, if you want to trade a session, you need to choose only one and do it. So let's say you want to trade London. You don't trade London and then New York, so only trade London and focus on the London. So the next step is, it's important that you trade one session, but also what is important is that you only trade one pair or one instrument. So it works literally on everything. It works on crypto, stocks, forex, options, but it's important that you only focus on one. You don't want to be trading 5 different pairs, instruments or options or whatever. You want to only choose one session, one pair, and focus on that, because that is what is going to make you consistent profits in the longer run. And the next thing is, if you want to actually claim my free setups rating guide, which will be linked down there in the description, you can do that right now, or after this video, but that will just help you out to have some kind of a cheat note by your side while you are trading this strategy. So let's right now actually go to the live examples. Okay, so here we are at the actual market open. So let's start with the steps as we just said. So the first thing that we need to make sure is that market open is just about to happen, and it is. So the next step that we want to do, and the first step, is basically just mark out highs and lows. So how do we actually do that? So if I zoom in the chart a little bit like this, what we do is we take our tool for marking out a line. So first of all, we can see this massive obvious slowdown here, so we just mark it out like this. So we got a low out of the way, because we can see that that is only low down here so far. So the next step is we want to see for some highs. So you can see that we have two highs right here. So if you take this tool, you can see that we made a low right here, then after that a high and a low, then we made this high right here, and then you can see that market went all the way down here, made this low, this high, and then we dumped and made this low. So this is kind of the market structure that we actually have. And if we just want to mark out, we can see that we have this high right here and then this high right here. So we can mark out both highs. So it's not really important to mark out both, because if we get the sweep of the one high, that is going to be completely enough for us to enter the trade, but we can just, for the sake of it, mark out both of them. So let's actually, after we marked out on the 5-minute time frame all the highs and the lows, we can actually scale down to the 1-minute time frame. So let's go to the 1-minute time frame, and all we do right now on the 1-minute time frame is we just wait for the sweep of the one side. So let's see what is actually going to happen. So there it is. So we swept to the upside. So I'm going to move these lines like this, because we actually have the sweep. So that's it. The second step is actually out of the way. So we are literally on a third step so quickly. So all we need to do right now is we need to see a fair value gap in the market that was last created. So we can see right here we already have a fair value gap. So if I want to move this by the side so we can clearly see the fair value gap, you can see if we take the rectangle tool, we have a wicks high right here, and then we have right here a wick low. So we don't even have the wick on this candle, but this is the low, complete low of that candle. So this right here is our fair value gap. So what do? We just wait for the inversion of that fair value gap, because we already made a manipulation. We left an imbalance that we can wait for the market to disrespect so we can enter the position. And then right now all we have to do is we have to enter the position, and there it is. So you can see right now we inverse the last fair value gap. You can also see that we have a small fair value gap right here that was previous to this one, and it was also disrespected. So market is clearly showing us that it wants to go to the downside. So if I put my order like this right here, we put our stop loss above the fair value gap or above the candle that inversed it. Is the same thing in this scenario. And what do? We target towards the downside, towards this low right here. So let's actually play forward the market and see what actually happens. So this is incomplete 3.5 risk to reward. So you can see it took maybe about half an hour to play out, which was a lot slower than usual, but in the most cases it's going to take about 10 minutes or 5 minutes to play out towards the TP. And in this case you can see we made 5.53 risk to reward, which I always like to add. A simple $100,000 fund account will result to you, if you risk 1%, making a $3,500 with this single position right here this day. So I hope that makes some kind of sense how powerful this can be. So let's actually go to the second example. Okay, so here we are at the actual second market open. We have so the same thing as the first time. We want to be at the beginning of the market open, whatever market, it doesn't matter, and whatever session, it doesn't matter. So just make sure you trade one session and one market. The second thing is on the 5-minute time frame. As you can see, we already are. We want to mark out lows. So in this case, we have this low right here, and then we have this low right here. So as long as we get the sweep of the one low, that is completely enough for us to target another side. So then after that, you can see that we have this low right here, and I'm not going to mark out this high because it was just created like few minutes ago, and we do not want to seek for that liquidity. We want to look for the liquidity that was created prior to actual market open. So we can also mark out this liquidity right here just for the sake of it. And let's right now scale down to the 1-minute time frame, which is what we always do. and what we are going to wait for is a manipulation. So let's see if that actually happens. So we manipulated to the downside and we swapped this both liquidity points. So if we swapped one liquidity point, that will be enough, but since we swapped two, that is just kind of even a better confluence that market just took a lot more stop losses and is a lot more likely to actually reverse all the way to the upside. So right now, if you want to look for the fair value gaps in the market, you can see that we have a small fair value gap right here, but sometimes these fair value gaps can be so small that it's not really good to enter from them. So if we look to the upside, we can see that we have one bigger fair value gap right here. So let's right now see what the market is actually going to do. So in this case, it would be nice to inverse both of these fair value gaps so we are 100% sure that the market is not going to stop us out or do anything like that. So let's see what the first candle is going to look like. So we inversed the first fair value gap, the small little one, but I'm actually going to wait so we inverse the second. If that happens, I'm going to enter the trade, and there it is. So we are just going to enter the position right here. So it was something that I just wanted to make sure before we enter the position. It doesn't cost you anything to miss out on a move, since we can't even miss out because we have the second fair value gap that will get inversed or will not, and the trade will lose. But if it gets inversed, we are just going to enter the same position as down here. So we put our stop loss underneath the candle low or underneath the fair value gaps that we inverse. So I'm going to put it like this. And what do we target? We target a high that we previously marked to the upside. And let's see how is it actually going to play out to the upside. So you can see right there, this trade actually took like 10, maybe 12 minutes to play out. And that is the beauty of it. So 3 risk to reward. So the same thing as before, $100,000 funded account with 1% risk. This would be $3,000. So I hope you guys understand the value of this strategy and how good and powerful this can actually be in the markets. And I just have to ask, if you like the video, if you found it useful, make sure to leave a like, subscribe to the channel, maybe comment something, so it's just gonna make me know that I'm doing something right. Also, you can claim the playbook down there in the description as I told you. And the one more thing I want to add is right now I still have some ongoing spots in my mentorship. So it's a one-on-one mentorship where I do mentor people completely one-on-one. So if you are maybe interested in that and you maybe want to see if you are a right fit for it and maybe you actually get to go into it and get mentored by me, make sure to check out the link down there and book a call. So with all of that being said, I'm going to see you in the next video. Peace.